Hello everyone, I am Paul. Good to see you again. The global macroeconomic ledger is currently engaged in a high-stakes game of geopolitical Russian roulette, balancing the inflationary dread of a paralyzed Middle East against the euphoric, unbridled capital expenditures of the artificial intelligence supercycle. This precarious balancing act serves as mere prologue to the structural anomalies lurking beneath the surface of the equity indices. Anomalies that will be ruthlessly exposed during the fundamental dissection of the hyperscaler margin collapses later in this report. The margin for error has evaporated entirely, and traditional macroeconomic models are failing to compute the current reality. Let's start from the macro. The Quantamental analysis presented in this report systematically disaggregates two incredibly powerful, diametrically opposed macroeconomic forces to identify actionable investment positioning. The current macroeconomic and geopolitical landscape map the volatile intersection of military blockades, energy convexity, and central bank policy divergence. We are all feeling the fractured nature of the global economy. A grinding two-month military conflict between the United States and Iran has fundamentally shattered global energy supply chains, necessitating the deployment of military forces to break the blockade in the Strait of Hormuz. The traditional macroeconomic gravity, war, inflation, and supply chain friction, together with the AI capex supercycle, a phenomenon characterized by unprecedented capital expenditure in artificial intelligence infrastructure. This supercycle is actively and somewhat astonishingly decoupling the technology and semiconductor sectors from the geopolitical drag detailed on the geopolitical conflicts. The market is essentially operating in two distinct physical realities simultaneously. The strategic directive embedded in the center of this dichotomy is explicitly clear. Discipline over FOMO, fear of missing out. Target equities within the strategy, spanning from Nvidia to SK Hynix, have already experienced violent upward re-ratings, surging between 10% and 47% since our March briefing this year. For unallocated capital, the mathematical imperative demands patience. Patient investors may not chase these vertical rallies, but instead await optimal deployment windows for a much better risk-reward ratio. The US-Iran conflict provides a stark, tactical military overview of the crisis. See this detailed geopolitical map of the Gulf of Oman, explicitly highlighting the contested maritime zones, the Strait of Hormuz, and the specific locations of alleged military engagements. Over the trailing 3 months, this specific geographic bottleneck has served as the absolute dominant driver of the geopolitical risk premium injected into global asset prices. Triggered in late February 2026, following coordinated United States and Israeli kinetic strikes on Iranian military targets, the conflict has generated an accumulated fiscal burn estimated at $25 billion to date. The core of the standoff centers on Iran's retaliatory closure of the strait and the subsequent US naval blockade of Iranian ports in the Gulf of Oman. It facilitates the transit of approximately 20% of global oil exports, alongside massive critical volumes of liquefied natural gas, agricultural fertilizers, and helium. To counter this paralysis, Operation Project Freedom, a sweeping maritime and military operation, launched officially on May 4, 2026. See this quantified immense scale of the US Central Command CENTCOM deployment, an imposing force of 15,000 military personnel, over 100 land and sea-based aircraft, multi-domain unmanned platforms, and a vanguard of guided missile destroyers. The risk environment remains extraordinarily hostile, a dynamic that the market is actively struggling to price accurately. Iranian state media claimed on the morning of May 4th that the Islamic Revolutionary Guard Corps, IRGC, successfully fired 2 missiles at a US Navy frigate near Bandar-e-Jask. This fog of war is directly translating into severe logistical friction. The cascading economic and logistical consequences of the blockade are mathematically dissected. Complex charts here highlight the multi-tiered structural impacts of the global oil export constriction. The first metric reveals the hyperinflation of maritime insurance. Freight and war risk insurance premiums for traversing the strait have violently surged from a baseline of 0.125% to a crippling range of 0.2% to 0.4% of total hull value. This sudden premium explosion adds hundreds of thousands of dollars in baseline transit costs per individual vessel. Because many operators simply refuse to underwrite this level of kinetic risk, approximately 20,000 commercial seafarers are currently physically trapped in the region, unable to secure safe transit. The second major data point quantifies a profound, permanent restructuring of global supply chain philosophy. In its place, corporate enterprises are rapidly pivoting toward a capital-intensive, just-in-case inventory model. This structural shift has created a massive, immediate demand shock for industrial warehousing, geographically evidenced by a staggering 50% surge in operating and warehousing costs for Hong Kong's commercial sectors since the conflict's onset. The final metric exposes the catastrophic fiscal damage inflicted directly on Tehran by the US blockade. The Iranian government is currently collecting less than $1.3 million in daily shipping tolls, a negligible fraction of its former daily oil revenues. This blockade inflicts severe economic distress on the Iranian state, forcing the government into the rapid, desperate filling of domestic onshore storage and preparing for imminent, highly damaging oil well shut-ins. What happens when geopolitical missiles meet a global market completely out of shock absorbers? Oil goes parabolic, inflation gets stickier than spilled honey, and investment might just become the collateral damage. Stick around, and I'll show you exactly why a synchronized global recession might be looming just around the corner. Right now, energy markets are exhibiting extreme inelastic sensitivity. They are tighter than a snare drum. The convexity rule mathematically dictates that a mere 1% loss in global oil supply historically triggers an outsized 4% spike in benchmark crude prices. We saw this extreme convexity manifest violently during the peak escalation window on May 1st. Brent crude surged 7.3%, cleanly slicing through the $126 per barrel threshold. We've temporarily settled into a highly volatile trading zone between $107 and $114 a barrel. But do not let that pullback lull you into complacency. The underlying systemic risk is still critically elevated, underscored by recent drone attacks on UAE-flagged tankers and emergency missile alerts. This persistent energy shock isn't just geopolitical noise. It acts as a severe, highly regressive tax on global consumption and corporate operating margins. The math here is brutal. If this military conflict persists for 90 days, with oil sustained above that $100 per barrel mark, Gulf Cooperation Council food staples manufacturers face an imminent and devastating 300 basis points of gross margin compression. That is a massive hit to the bottom line. Macroeconomic picture. JP Morgan's models are practically screaming. They anticipate that if oil remains pinned above $120 for an extended duration, it will inevitably trigger severe global demand destruction. This persistent energy shock is fundamentally scrambling inflation expectations worldwide, forcing central banks into deeply divergent and, frankly, panicked monetary postures. Global monetary policy isn't just diverging, it's undergoing a violent tectonic shift. While global core CPI stubbornly hovers around 2.8% in 2026, the world's major central banks are fundamentally abandoning the buddy system. We are looking at a rapid, highly contradictory fracturing of policy paths. Let me break down the chaos. First, the US Federal Reserve. They are completely boxed in, with persistent goods price pressures pushing domestic inflation above 3.2%. The Fed is trapped holding policy rates at 3.5% to 3.75%. The FOMC is severely divided, suffering an unprecedented 4 dissents and 1 rogue vote for a 25 basis point cut at the latest meeting. They are officially sweating. Meanwhile, across the Atlantic, it's a completely different party. Western European inflation is cooling toward 1.9%, giving the European Central Bank the green light for an aggressive easing cycle, projected to slash the policy rate down to 1.5%. The Bank of England is following suit, forecasting a drop to 2.75%. And then there's the Bank of Japan. The BOJ remains the massive global anomaly, actively hiking its policy rate to 0.75% by December. Put this all together, and this profound divergence is basically high-octane fuel for violent currency volatility and massive cross-border capital flows. Direct your attention to the market resilience line chart on the screen. Focus specifically on the 5-day rolling beta, mapping the S&P 500 index against oil prices. Right now, that rolling beta sits at a very modest minus 0.10. Compare that to the extreme peak beta inversions of minus 0.54 we saw earlier in 2026. The equity markets have effectively digested the realities of the war. The panic is gone, and sensitivity to crude volatility has severely dampened. It's as if the market simply put on noise-cancelling headphones. And why? Because portfolios are heavily anchored by structural taco trades and longer-term conviction on AI. Complex, insulated positioning built during previous global trade wars, specifically designed to shield targeted tech equities from extreme oil shocks. But which specific equities are actually surviving and thriving from this insulation? You're going to want to see the exact regional performance breakdown I'm about to reveal next. If you think the global economy is moving as a single monolith right now, you are reading the wrong charts. Between February and May of 2026, global market resilience fractured entirely down one specific fault line: artificial intelligence. Global resilience is highly bifurcated and almost entirely underwritten by the tech sector. The South Korean Kospi didn't just lead the pack, it completely obliterated it, surging a staggering 28.3% and shattering the historic 6,800 index level. This wasn't a rising tide lifting all boats. This was a tsunami of capital chasing domestic AI memory chip makers like SK Hynix and Samsung. This semiconductor mania pushed regional ETF liquidity in South Korea to an eye-watering $724 billion in the first quarter. The rest of the tech world naturally caught the exact same tailwind. The Nasdaq 100 posted a robust 11.6% gain, driven by relentless AI capital expenditure from megacaps and structural earnings beats. Japan's Nikkei 225 rallied 9.4%, riding its monopolistic chokehold on the semiconductor wafer fab equipment supply chain. When bellwethers like Tokyo Electron report operating incomes 14% above consensus estimates, the market listens and it buys. Even the broad S&P 500 managed a 5% return, marking 5 consecutive weeks of gains, its longest weekly advance since 2024. But let's shift to the Chinese markets, where the narrative gets significantly more complex. The Shanghai Composite posted a modest 1.9% gain. Do not let that aggregate number fool you. It obscures a massive structural pivot occurring right beneath the surface. Beijing is aggressively stimulating the economy via loosened credit policies, projecting a 25% rise in brokerage fees for firms like Guosen Securities. But the real story is in the hardware. The domestic Chinese tech sector is executing a massive white box server pivot. They are deploying ARM-based platforms at a 12% to 15% rate to deliberately bypass Western x86 supply chain vulnerabilities. At the same time, they are integrating advanced liquid cooling into 30% to 35% of all new hyperscale builds. They are literally building their own walled garden. Unsurprisingly, indices heavily exposed to geopolitical drag and legacy industries floundered. The US Dow Jones lagged the broader markets with a negative 0.5% return, choked by input cost inflation and ongoing supply chain frictions. And then there is the Hong Kong Hang Seng. It remains the ultimate global laggard at negative 3.1%, crushed by real estate sector weakness and geopolitical dread. So, the tech insulation is clear, and AI is carrying the market on its back. But how long can this safety net hold up against deteriorating macroeconomic fundamentals? We will see. The bifurcation gets exponentially more violent when you look under the hood at thematic sector flows. Over the first 85 trading days of 2026, the market has developed a ruthless, undeniable preference for physical hard assets and concrete infrastructure. If you can't touch it, the market probably hates it right now. Look at the semiconductor performance metrics mapping out on the screen. The SOXX ETF is up 55.8%, and the SMH ETF is trailing right behind at 42.4%. OMG! The math confirms a terrifying reality for anyone caught short. Semis haven't just recovered, they have violently transitioned into a historic, structural growth supercycle. Driven by an insatiable global appetite for AI processing and data center networking, worldwide semiconductor revenue is forecast to rip 64% higher in 2026, easily smashing through the $1 trillion valuation mark. Wafer fab equipment spending is projected to hit an unprecedented $130 billion, with memory architecture hijacking up to 70% of this massive capex upcycle. Symmetrically, the old economy is roaring back. Energy and materials, with the OIH up 55.6% and the XLE up 31.7%, are aggressively pricing in the geopolitical risk premium, choking the Strait of Hormuz. But the hard asset squeeze goes deeper. Copper prices are mathematically projected to hit $6.1 per pound due to the massive unforeseen power deficits generated by electrifying these new AI data centers. Concurrently, physical gold is expected to surge 39.3% to average $4,700 an ounce, driven entirely by relentless, price-agnostic accumulation by central banks. If physical infrastructure is the undisputed winner, let's talk about the victims. The software sector, tracked by the IGV ETF, is down 16.7%. It is the market's most severe underperformer, presenting a massive bleeding divergence from the broader tech rally. Front office application producers slid an abysmal 30% through late April. The underlying fear here is profound. Autonomous AI agents threaten to permanently cannibalize traditional software seats. Corporate enterprises are radically redirecting their IT budgets away from software upgrades, shoveling that capital directly into hardware. Why pay for a SaaS subscription when an AI agent can do it for free? However, there is a defensive silver lining hiding in the rubble. Take a look at the financial sector, currently sitting at negative 5.3%. While it's lagging the massive momentum rotation, the banking sector is sitting on a structural powder keg. Deep AI integration within banking workflows is projected to drive an astonishing 20 to 50% productivity boost over the next decade. If realized, this productivity surge could yield an estimated 18% improvement in aggregate pre-tax income for the sector. The multi-trillion-dollar question is, how much of this future AI productivity is already priced into current banking valuations? To answer that, we have to immediately dissect the broad market fundamentals, which I'm about to show you next. If you are holding the broad index right now, you aren't diversified. You are just holding a mega cap grenade with the pin pulled. Let's look at the terrifying math holding this market together. Direct your attention to the three critical aggregate metrics mapped out on the screen: earnings velocity, valuation constraints, and historic concentration. The good news is, the fundamental base supporting this rally is undeniably robust corporate earnings velocity. For the first quarter of 2026, the blended year-over-year earnings growth rate for the S&P 500 stands at a staggering 27.1%. That is the highest absolute growth rate achieved since the post-pandemic euphoria of late 2021. And the breadth of this outperformance is an absolute steamroller. With 63% of companies having reported, an overwhelming 84% have posted positive earnings surprises, and 81% have delivered positive revenue surprises. But here is the dark side of this reality. These robust fundamentals are perfectly priced in, leaving virtually very thin margin for error. Look at the valuation constraints metric. The S&P 500 currently trades at a highly stretched forward 12-month price-to-earnings ratio sitting between 20.9 and 22 times, depending on your consensus model. Also, a historic concentration risk. The top mega-cap technology stocks now account for an unprecedented 53% of the index's total return share. The bullish projection is rigidly predicated on two highly fragile assumptions. achieving 12% EPS growth in 2026, followed by 10% in 2027, along with the strict total containment of geopolitical friction in the Middle East. Good luck with that.